Welcome to The Explainer. Today, we're looking at a quiet little memo that's come out of China, and it has the financial world buzzing. Now, on the surface, it seems like just some boring, bureaucratic advice about U.S. debt, but it might just be the clearest signal we've gotten yet that the fundamental rules of the global economy, well, they're being rewritten right before our eyes. Okay, so let's get right into it. A recent report from Bloomberg dropped a little bombshell. Chinese regulators are quietly telling their own financial firms to ease up on buying U.S. government debt. And the reason they give? Concentration risk and market volatility.
Now, at first glance, that just sounds like, a boring internal memo. But here's the thing. That's not really how China operates. They don't usually make big, loud statements. They make policy changes, and they do it quietly but very firmly. So in the world of high finance, where the biggest moves often start with a whisper, not a shout, you have to ask, what is really going on here?
To really get the impact of what China's doing, we first need to understand what's at stake, and that means we need to talk about U.S. Treasuries.
See, these aren't just any old government bonds. For decades, they've been the bedrock of global finance, the safest of the safe havens. But it's more than that. They are the literal structural core of the entire modern financial system.
And their role is absolutely central. The global system doesn't just like U.S. Treasuries. In a lot of ways, it survives because of them. There's this core assumption that's been built into decades of financial plumbing that U.S. debt will always be easy to sell, politically neutral, and stable enough to handle any crisis. And that is the assumption that's now being put to the test.
So why would China, one of the biggest owners of U.S. debt on the planet, start to hedge its bets? Well, it's complicated, but it really boils down to two key things. The first driver is pure geopolitics. Look, after Russia's foreign reserves were frozen back in 2022, the game completely changed. The whole idea that these assets were somehow above politics, that went out the window. For a country like China, the signal was loud and clear. If you hold US dollars, you are exposed to US policy. This is all about lowering that risk for the future. But hey, it's not all about geopolitics. The second driver, and it's right there in the advisory itself, is just good old-fashioned risk management. Because the once boring, predictable, and super stable nature of U.S. Treasuries, well, that's fundamentally changed in the last few years.
And you can really see the shift right here. For most of the last 40 years, Treasuries were, frankly, kind of boring. But after 2020, everything changed. Yields shot up from basically 0 to over 5%. And this wasn't some minor little wobble. It caused one of the most painful hits in the history of the modern bond market. We're talking huge losses for people who thought they owned the safest asset in the world.
So what happened? It was a perfect storm, really. You had the U.S. running wartime-sized deficits when there was no war, adding over $7 trillion in debt in just a couple of years. Then, boom, the Fed slammed on the brakes, hiking interest rates faster than they had in 40 years. And on top of all that, you have the constant political drama over debt ceilings. Suddenly, U.S. politics itself became a risk factor.
Okay, so China's clearly trying to lower its risk, but they're not just dumping all their bonds on the market overnight. So how can a quiet move like this still put so much pressure on the system? The answer is something called the marginal buyer effect.
Look, China can't just have a fire sale. That would crash the value of their own holdings. It would be like shooting themselves in the foot. So the key here isn't about the biggest holder selling everything at once. It's about who the last buyer is at the auction. That's the marginal buyer.
So here's how it works. When the U.S. government needs to borrow money, it holds an auction. Buyers put in their bids. The Treasury takes the best offers until it's sold all the debt it needs to. But the interest rate paid by that very last buyer, the one who just barely gets in, that sets the rate for the entire auction. So if that final buyer gets a little nervous and demands a higher interest rate, or maybe even just decides to sit this one out, the cost of borrowing for the U.S. government goes up for everybody.
And does this really matter? Oh yeah, even a pretty modest slowdown, say 5 to 10%, in new purchases from Chinese buyers could push U.S. interest costs up by an estimated $30 to $90 billion a year. That's not chump change, that's real money, and it's driven by a small change at the margins.
All right, let's zoom out and look at the big picture, because this all leads to a really important final takeaway. What does this quiet, kind of technical shift really mean for the U.S. and for the rest of the world?
It's really tempting to call this de-dollarization, but honestly, that's too simple. It kind of misses the point. China isn't trying to blow up the dollar system. It can't. What it's doing is strategically reducing how much it depends on that system. The difference is subtle, but it's absolutely critical. See, dependence gives the US leverage. Diversification reduces that leverage.
And this isn't some plan for the future. It's a trend that's already happening. I mean, look at this. While China is still a huge holder, its stockpile has fallen to the lowest level since 2008. It's down by nearly half from its peak back in 2013.
And listen, this isn't just a China story. It's part of a much bigger trend. Other major economies like India and Brazil are also trimming their holdings. And then look at the other side of the coin. While they're selling US debt, China has been steadily buying physical gold, an asset you can't just sanction away with the push of a button. That is diversification in action.
So, here it is. Here's the most important point. This story isn't about the dollar collapsing tomorrow. It's about the end of an assumption, the American privilege of being seen as the world's only stable, predictable, and unchallenged economic anchor. That privilege is slowly being repriced by risk managers all over the world.
This quote just nails the new reality. The world is becoming less binary. Countries are hedging their bets. They're looking for optionality. It's not about replacing the US system. It's about ensuring yourself against a world where no single power is trusted enough to bet the entire farm on. So yeah, this story matters. A lot. Not because of one little advisory, but because of what it shows us about how the world is quietly getting ready for a very different tomorrow. It's not a bet on collapse. It's a rational, logical preparation for a future that's got more players, more volatility, and a lot less certainty. And it leaves us with a really critical question. If the world isn't betting on a collapse, what exactly is it preparing for?